Question 1. During an emergency response where multiple areas are impacted, a publicly traded company discovers that one of its executives engaged in undisclosed securities transactions using material non-public information (MAPI). The company's compliance officer is tasked with determining potential violations under U.S. securities laws. Which of the following is the most accurate legal assessment of the executive's actions? A. The executive is only liable if the company suffered financial losses due to the transactions. B. The executive may be held liable under Rule 10(5) of the Securities Exchange Act of 1934 regardless of whether the company itself was harmed. C. The executive is only liable if the trades occurred within blackout periods specifically set by the company's internal policies. D. The executive is not liable if they personally profit from the transactions. Answer: B. The executive may be held liable under Rule 10(5) of the Securities Exchange Act of 1934 regardless of whether the company itself was harmed. Explanation: Rule 10(5) under the Securities Exchange Act of 1934 prohibits fraudulent and deceptive practices in connection with the purchase or sale of securities. Insider trading occurs when an individual trades based on MAPI and breach of its trust or confidence. The SEC does not require proof that the company suffered financial losses, only that the executive traded on MAPI. The classical theory of insider trading applies here, as the executive had fiduciary duty to the company. A. Incorrect. Liability under Rule 10(5) does not depend on whether the company itself experienced financial losses. The focus is on whether the executive engaged in deceptive conduct. B. Correct. SEC enforcement actions target individuals who misuse MAPI regardless of direct harm to the company. Courts have upheld this interpretation in cases such as United States v. O'Hagan, 1997. C. Incorrect. Trading liability is not contingent on internal company blackout periods. Even if blackout period was not in effect, trading on MAPI can still be illegal. D. Incorrect. Gaining personal profit is not requirement for liability under Rule 10(5). Even avoiding loss or passing information to another trader, tipper liability, can result in penalties. Question 2. While analyzing the root causes of sequential problems in public offerings, a securities lawyer is asked to evaluate the legal requirements for an issuer conducting a Regulation D offering under Rule 506. C. Which of the following is a critical compliance requirement for such an offering? A. The issuer must provide a prospectus that meets the requirements of the Securities Act of 1933. B. The issuer can raise an unlimited amount of capital but must verify that all investors are accredited. C. The issuer is prohibited from using general solicitation or advertising to attract investors. D. The issuer must register the offering with the SEC and comply with periodic reporting requirements. Answer: B. The issuer can raise an unlimited amount of capital but must verify that all investors are accredited. Explanation: Rule 506. C of Regulation D under the Securities Act of 1933 allows issuers to engage in general solicitation and advertising while raising an unlimited amount of capital. However, the issuer must take reasonable steps to verify that all investors are accredited, i.e., they meet income or net worth thresholds set by the SEC. A. Incorrect. Rule 506. C. Offerings are exempt from full SEC registration and do not require a prospectus in the form required for registered public offerings. Instead, issuers typically provide a private placement memorandum. B. Correct. Rule 506. C. Permits an unlimited capital raise, but strict verification of accredited investor status is mandatory. Acceptable verification methods include reviewing returns, bank statements, or obtaining a certification from a licensed financial professional. C. Incorrect. Unlike Rule 506, B. Rule 506. C. expressly permits general solicitation and advertising. This distinction was established under the Jobs Act of 2012. D. Incorrect. Although issuers must file a Form D with the SEC, they are not required to register the offering or comply with periodic requirements applicable to public companies. Question 3. During a major transformation where existing methods of market regulation are being challenged, the SEC is considering enforcement action against a trading firm suspected of engaging in manipulative activities under Section 9A of the Securities Exchange Act of 1934. Which of the following trading practices would most likely be considered unlawful market manipulation? A. Placing large trades at different times of the day based on market trends. B. Engaging in wash sales to create artificial trading activity and mislead investors. C. Executing trades based on proprietary algorithms designed to capitalize on arbitrage opportunities. D. Buying shares before a positive earnings announcement and selling after the price increases. Answer B. Engaging in wash sales to create artificial trading activity and mislead investors. Explanation. Section 9(a) of the Securities Exchange Act of 1934 prohibits certain manipulative practices, including wash sales, matched orders, and false trades designed to create misleading market activity. Wash sales occur when a trader buys and sells the same security to create the illusion of demand, potentially misleading investors. A. Incorrect. Trading based on market trends is not inherently manipulative unless accompanied by deceptive practices intended to mislead the market. B. Correct. Wash sales are a form of market manipulation explicitly prohibited under Section 9(a). The SEC has brought enforcement actions against firms engaging in such practices to artificially inflate trading volume. C. Incorrect. Algorithmic trading based on legitimate strategies does not constitute manipulation unless it involves deceptive tactics, such as spoofing or layering. D. Incorrect. Buying shares before positive news and selling afterward. Legal insider trading based on public information is generally permissible unless the trader had access to MFA. Question 4. During a period of increased financial market volatility where risk management is critical, a global investment bank is evaluating its exposure to credit default swaps, CDS. The firm's risk management team is concerned that significant counterparty may default on its obligations, potentially triggering systemic repercussions. Under the Dodd-Frank Act, which regulatory requirement is most relevant to mitigating counterparty risk in the over-the-counter derivatives market? A. Mandatory central clearing of standardized derivatives contracts to reduce counterparty risk. B. Allowing firms to engage in unlimited bilateral derivative agreements without regulatory oversight. C. Eliminating reporting requirements for swaps to maintain market confidentiality. D. Restricting all derivative trading to government-approved institutions only. Answer A. Mandatory central clearing of standardized derivatives contracts to reduce counterparty risk. Explanation. The Dodd-Frank Act introduced significant reforms to the derivatives market, including the requirement that standardized derivative contracts be cleared through central counterparties (CCPs). This measure reduces counterparty risk by ensuring that a clearinghouse stands between the two parties to a trade, guaranteeing settlement, even if one party defaults. Bilateral trading without oversight, option B, increases systemic risk. Eliminating reporting requirements, option C, would reduce market transparency. Restricting derivatives trading solely to government-approved institutions, option D, would be overly restrictive and could hinder financial market efficiency. Question 5. During an internal compliance audit where regulatory adherence is under review, a publicly traded company is found to have made selective disclosures of material non-public information to certain institutional investors. The company's legal team is concerned about potential violations of the SEC's Regulation FD, Fair Disclosure. Under this regulation, what steps should company take when unintentional selective disclosure of material information occurs? A. The company must make prompt public disclosure of the material information to ensure broad market access. B. The company may continue to provide selective disclosures as long as recipients agree to confidentiality terms. C. The company should instruct institutional investors to refrain from trading on the information but take no further action. D. The company is only required to disclose the information publicly if the SEC initiates enforcement action. Answer A. The company must make prompt public disclosure of the material information to ensure broad market access. Explanation. Regulation FD was enacted to prevent selective disclosure of material non-public information to favored investors. If a company unintentionally discloses such information to a limited group, it must promptly make the same information available to the public, typically via press release or SEC filing. Confidentiality agreements, option B, do not negate the requirement for public disclosure. Simply instructing investors not to trade, option C, is inadequate, as the damage may already be done. Waiting for a SEC enforcement action, option D, is not compliant with Regulation FD. Question 6. During a government antitrust investigation where competitive market structures are being analyzed, regulators are assessing whether a proposed merger between two major technology firms would substantially reduce competition. Under the Clayton Antitrust Act, which of the following factors is most critical in determining whether the merger should be blocked? A. The geographic locations of the company's headquarters and manufacturing facilities. B. The potential for the merger to create monopoly or significantly reduce consumer choices. C. The combined company's overall revenue and net profit. D. The level of media attention and political scrutiny surrounding the merger. Answer: B. The potential for the merger to create a monopoly or significantly reduce consumer choices. Explanation: the Clayton Antitrust Act prohibits mergers and acquisitions that substantially lessen competition or tend to create monopolies. The most critical factor in evaluating a merger is whether it would give the combined company excessive market power, leading to higher prices, reduced innovation, or fewer choices for consumers. Location, option A, is secondary unless it directly affects competition. Revenue and profit, option C, do not necessarily indicate antitrust concerns. Media attention, option D, does not determine whether a merger violates antitrust laws. Question 7. During an internal ethics review where corporate governance standards are being evaluated, a multinational corporation is considering new policies regarding executive compensation. Shareholders have expressed concerns that excessive executive pay may not align with company performance. Under the Dodd-Frank Act, which corporate governance rule is designed to enhance transparency and accountability regarding executive compensation? A. The requirement for companies to disclose the ratio of EO pay to median employee pay. B. The elimination of all forms of performance-based executive compensation. C. The requirement for executives to receive uniform salaries across all industries. D. The restriction of stock-based compensation in publicly traded companies. Answer: A. The requirement for companies to disclose the ratio of EO pay to median employee pay. Explanation: the Dodd-Frank Act introduced the EO pay ratio disclosure rule, which requires publicly traded companies to disclose the ratio of the CEO's total compensation to the median employee's pay. This measure aims to increase transparency and allow investors to assess whether executive compensation aligns with company performance. Eliminating performance-based compensation, option B, is not Dodd-Frank requirement. Mandating uniform salaries across industries, option C, would be impractical and outside regulatory scope. Restricting stock-based compensation, option D, would limit companies' ability to attract top executives. Question 8. During a financial market downturn where liquidity concerns are heightened, a major investment firm is reviewing its compliance with capital reserve requirements. Regulators are particularly concerned about whether the firm maintains sufficient capital to withstand economic shocks. Under the Basel framework, which of the following is a key requirement for financial institutions regarding capital adequacy? A. Maintaining a minimum Tier 1 capital ratio to absorb losses during financial stress. B. Reducing capital reserves to maximize profitability during stable economic periods. C. Eliminating all forms of debt to improve financial stability. D. Increasing speculative investments in high-yield securities to offset capital shortfalls. Answer: A. Maintaining a minimum Tier 1 capital ratio to absorb losses during financial stress. Explanation: Basel rule requires financial institutions to maintain a minimum Tier 1 capital ratio to ensure they can absorb losses during financial downturns. This regulatory framework was designed to strengthen bank capital requirements and reduce systemic risk. Reducing capital reserves, option B, would increase financial instability. Eliminating all debt, option C, is not a requirement, as responsible debt management is part of financial strategy. Increasing speculative investments, option D, would elevate risk rather than mitigate it. Question 9. During a cybersecurity risk assessment where regulatory compliance is under review, a financial institution is evaluating its obligations under the Gramm-Leach-Bliley Act GLBA. Regulators are emphasizing the need for strong consumer data protection measures. Under the GLBA, which of the following is a key requirement for financial institutions? A. Implementing safeguards to protect customer financial information from unauthorized access. B. Publicly disclosing all customer financial transactions for transparency. C. Storing customer financial data indefinitely regardless of security risks. D. Allowing unrestricted third-party access to customer account details. Answer: A. Implementing safeguards to protect customer financial information from unauthorized access. Explanation: The Gramm-Leach-Bliley Act requires financial institutions to implement safeguards to protect the confidentiality and security of customer financial information. Publicly disclosing transactions, option B, would violate privacy laws. Storing data indefinitely, option C, increases security risks. Allowing unrestricted third-party access, option D, would compromise consumer protection. Question 10. During an economic policy debate where financial market regulations are under review, lawmakers are assessing the effectiveness of the Securities Investor Protection Act, (SEPA). This law was designed to protect investors in the event of brokerage firm failures. Under SEPA, what protection is provided to investors when a brokerage firm becomes insolvent? A. The Securities Investor Protection Corporation (SIC) ensures the return of securities and cash up to specified limits. B. The SIC guarantees the full reimbursement of all investor losses, regardless of the amount. C. The SIC provides insurance against market losses resulting from stock price declines. D. The SIC restricts investors from filing claims against failed brokerage firms. Answer A. The Securities Investor Protection Corporation (SIC) ensures the return of securities and cash up to specified limits. Explanation. SEPA established the Securities Investor Protection Corporation (SIC), which helps return securities and cash to customers of insolvent brokerage firms up to specified limits. It does not guarantee reimbursement of all losses, option B, or cover market losses, option C. Restricting investor claims, option D, would contradict SEPA's purpose of protecting investors. Question 11. During a regulatory compliance audit where consumer protection laws are under review, a large financial institution is assessing its adherence to the Truth in Lending Act (TILA). A recent review found that the institution failed to provide proper disclosures regarding loan terms and interest rates to borrowers. What consequence is most likely to result from this violation? A. The financial institution may be subject to fines and required to provide corrected disclosures to affected consumers. B. The financial institution may be required to immediately forgive all outstanding consumer loans. C. The institution's executives may be criminally prosecuted under federal anti-money laundering statutes. D. The affected consumers will automatically receive refunds for all interest payments made on their loans. Answer A. The financial institution may be subject to fines and required to provide corrected disclosures to affected consumers. Explanation. The Truth in Lending Act (TILA) requires lenders to provide clear disclosures about loan terms, interest rates, and repayment obligations. Failure to comply can lead to civil penalties, fines, and mandatory corrective disclosures. Lenders are not required to forgive all outstanding loans, option B, but liable for damages. Criminal prosecution under anti-money laundering laws, option C, is unrelated to TILA violations. Consumers do not automatically receive full refunds for interest payments, option D, though they may have legal recourse. Question 12. During a financial crisis where mortgage defaults are increasing, a government agency is reviewing the role of the Federal Housing Administration (FHA) in stabilizing the housing market. What is the primary function of the FHA in the mortgage lending industry? A. To ensure loans made by private lenders, reducing their risk and encouraging homeownership. B. To directly issue mortgage loans to consumers without involving private lenders. C. To regulate the pricing of all mortgages and set national interest rates. D. To provide grants that cover the full cost of home purchases for low-income borrowers. Answer A. To ensure loans made by private lenders, reducing their risk and encouraging homeownership. Explanation. The Federal Housing Administration (FHA) insures mortgage loans issued by private lenders, reducing lender risk and making homeownership more accessible. The FHA does not directly issue loans, option B. It works with lenders. It does not regulate mortgage pricing or interest rates, option C, which are influenced by market conditions and the Federal Reserve. It also does not provide grants covering the full cost of home purchases, option D. Question 13. During a corporate fraud investigation where accounting irregularities are being examined, auditors discover that a company has been intentionally inflating revenue figures. Under the Sarbanes-Oxley Act (SOX), what legal consequences can corporate executives face for knowingly certifying false financial statements? A. Civil and criminal penalties, including potential prison sentences. B. A temporary suspension from working in any publicly traded company. C. A minor fine with no further legal action required. D. A requirement to issue a public apology, but no financial or criminal penalties. Answer A. Civil and criminal penalties, including potential prison sentences. Explanation. The Sarbanes-Oxley Act (SOX) holds executives personally responsible for financial disclosures. Knowingly certifying false financial statements can lead to criminal penalties, including imprisonment and heavy fines. Temporary suspension (Option B) may be part of regulatory action but is not the primary penalty. A minor fine (Option C) is sufficient given the severity of fraud. A public apology (Option D) is not an adequate legal consequence. Question 14. During an economic downturn where credit markets are tightening, businesses are facing increased scrutiny under the Fair Credit Reporting Act of CRA. Which of the following best describes a key requirement that lenders must follow when using consumer credit reports for lending decisions? A. Lenders must notify consumers if they take adverse action based on credit report information. B. Lenders may access consumer credit reports without any regulatory restrictions. C. Lenders are required to approve all loan applications to avoid potential discrimination claims. D. Lenders must share consumers' full credit reports with third parties, including potential employers. Answer: A. Lenders must notify consumers if they take adverse action based on credit report information. Explanation: The Fair Credit Reporting Act (FCRA) requires lenders to notify consumers if adverse lending decisions are based on credit report information, allowing consumers to dispute errors. Lenders cannot access credit reports without compliance. Option B. They are not required to approve all applications. Option C. But must follow fair lending practices. Sharing full credit reports with unauthorized third parties. Option D. Violates consumer privacy laws. Question 15. During a financial market downturn where investor protections are being debated, Congress is considering reforms to the Securities Act of 1933. What is the primary purpose of this act? A. To require full disclosure of material financial information before securities are offered to the public. B. To establish the Securities and Exchange Commission (SEC) as the main financial regulator. C. To regulate stock market trading by setting daily limits on price fluctuations. D. To prevent all foreign companies from issuing securities in U.S. financial markets. Answer: A. To require full disclosure of material financial information before securities are offered to the public. Explanation: The Securities Act of 1933 requires issuers to provide full financial disclosures before selling securities to the public, protecting investors from fraud. The SEC was created by the Securities Exchange Act of 1934, Option B. The Act does not set daily trading limits, Option C, or restrict foreign companies from issuing securities, Option D, though they must comply with U.S. regulations. Question 16. During an economic recession where unemployment claims are rising, the government is reviewing the role of the Federal Reserve. What is the Federal Reserve's primary tool for influencing monetary policy? A. Adjusting interest rates to influence economic activity. B. Directly controlling employment levels in the private sector. C. Issuing loans to individual consumers. D. Setting price limits on consumer goods and services. Answer: A. Adjusting interest rates to influence economic activity. Explanation: The Federal Reserve influences the economy primarily by adjusting interest rates through monetary policy tools such as the federal funds rate. It does not directly control employment. Option B. Issue personal loans. Option C. Or set consumer price limits. Option D. Though it monitors inflation. Question 17. During a financial crisis where bank failures are a concern, the Federal Deposit Insurance Corporation (FDIC) is evaluating its role. What is the FDIC's primary function? A. To insure deposits at member banks up to the coverage limit. B. To issue loans directly to struggling businesses. C. To set interest rates for all financial institutions. D. To regulate global currency exchange rates. Answer: A. To insure deposits at member banks up to the coverage limit. Explanation: The FDIC insures bank deposits to protect consumers in case of bank failures. It does not issue business loans. Option B. Set interest rates. Option C, which is done by the Federal Reserve, or regulate global currency exchange. Option D. Question 18. During a review of corporate governance standards where executive accountability is being evaluated, a major corporation is considering changes to its board structure. What is a key requirement under corporate governance best practices? A. Having an independent board of directors to oversee management. B. Allowing corporate executives to make all decisions without oversight. C. Eliminating shareholder voting rights to streamline decision-making. D. Preventing external audits to maintain confidentiality. Answer: A. Having an independent board of directors to oversee management. Explanation: best practices in corporate governance emphasize an independent board of directors to ensure management accountability. Eliminating oversight. Option B increases risk. Removing shareholder rights. Option C undermines investor confidence. Preventing audits. Option D reduces transparency and regulatory compliance. Question 19. During a debate on banking regulations where financial stability is being discussed, lawmakers are considering the impact of the Glass-Steagall Act. What was the primary purpose of this act? A. To separate commercial and investment banking activities. B. To deregulate the financial sector. C. To allow banks to engage in all types of financial activities without restrictions. D. To eliminate the role of the Federal Reserve. Answer: A. To separate commercial and investment banking activities. Explanation: the Glass-Steagall Act, 1933, separated commercial and investment banking to reduce financial risk. It did not deregulate the sector, option B, but imposed restrictions. Allowing banks unrestricted financial activities, option C, contradicts its purpose. The Federal Reserve remained intact, option D. Question 20. In a situation where formal requirements conflict with practical constraints, an engineering firm is developing a safety system for a large-scale industrial facility. The system must comply with stringent regulatory standards while also being cost-effective. What is the best approach to ensure compliance while maintaining feasibility? A. Strictly follow the formal requirements even if implementation is impractical. B. Identify and document key compliance priorities while negotiating flexibility where possible. C. Reduce costs by ignoring less critical regulatory requirements. D. Implement an alternative system without formal approval to avoid delays. Answer: B. Identify and document key compliance priorities while negotiating flexibility where possible. Explanation: balancing regulatory compliance with practical feasibility is essential in industrial safety systems. The best approach is to identify key compliance priorities while negotiating flexibility in non-critical areas. Option B. Rigid adherence to impractical rules. Option A. May hinder operations. Requirements. Option C. Could lead to legal and safety issues. Implementing an unapproved system. Option D. Risks liability and non-compliance penalties. Question 21. During a critical transition period where existing processes are being phased out, a healthcare organization is moving from paper-based records to a digital system. What is the most effective way to ensure a smooth transition while maintaining patient care quality? A. Immediately discontinue paper records and require staff to use the digital system. B. Provide phased training, dual systems operation, and clear support mechanisms. C. Let departments choose whether to adopt the digital system based on their preferences. D. Delay implementation indefinitely until all issues are resolved. Answer: B. Provide phased training, dual systems operation, and clear support mechanisms. Explanation: a phased transition with comprehensive training ensures that healthcare providers adapt without disruptions to patient care. Option A is too abrupt, risking errors and inefficiencies. Allowing each department to decide. Option C leads to inconsistencies and data fragmentation. Indefinite delays. Option D result in continued inefficiencies and outdated record keeping. Question 22. When implementing backup procedures across various departments, a financial institution must ensure that data is securely stored and quickly recoverable. What is the best method to achieve this goal? A. Maintain multiple redundant backup locations with frequent testing. B. Rely on a single backup stored in an off-site facility. C. Allow each department to choose its own backup process. D. Keep only real-time data without periodic backups. Answer: A. Maintain multiple redundant backup locations with frequent testing. Explanation: redundant backups with regular testing ensure data integrity and quick recovery in case of failure. A single off-site backup, option B, introduces risk if it becomes unavailable, allowing different departments to choose their methods. Option C creates inconsistencies, relying only on real-time data. Option D means data loss in case of corrupt cyber attacks. Question 23. In a multi-location scenario where consistency requirements are crucial, a logistics company is standardizing its supply chain processes. What strategy will best ensure uniform operations across all locations? A. Implement standardized procedures with periodic compliance audits. B. Allow each location to develop its own operational methods. C. Centralize all decision-making without considering local factors. D. Use outdated procedures since they have worked in the past. Answer A. Implement standardized procedures with periodic compliance audits. Explanation. Standardized procedures with compliance audits. Option A. Ensure consistency while allowing for adjustments as needed. Option B. Results in inefficiencies and lack of coordination. Full centralization. Option C. Ignores regional requirements. Using outdated methods. Option D. Prevents adaptation to new market conditions. Question 24. While analyzing the root causes of sequential problems in a manufacturing process, an automotive company notices increasing defects in production. What is the most effective way to identify and address the issue? A. Conduct. A root cause analysis, or CA, and implement process improvements. B. Increase production speed to compensate for losses. C. Ignore minor defects and only address major failures. D. Replace all machinery immediately without investigation. Answer A. Conduct a root cause analysis, CA, and implement process improvements. Explanation. Root cause analysis, CA, helps identify underlying problems and improve processes. Increasing speed, option B, worsens quality issues. Ignoring defects, option C, leads to higher costs and recalls. Replacing machinery without investigation, option D, is expensive and may not solve the issue. Question 25. During an emergency response where multiple areas are impacted, a disaster recovery team must prioritize actions. What should be their primary focus? A. Ensure immediate safety, stabilize critical infrastructure and coordinate resources. B. Wait for complete damage assessment before taking any action. C. Focus only on financial losses rather than safety measures. D. Handle the response one area at a time without overall coordination. Answer A. Ensure immediate safety, stabilize critical infrastructure and coordinate resources. Explanation. Emergency response prioritizes safety, stabilization and coordination. Option A. Waiting for full assessment. Option B. Delays critical response. Focusing only on financial losses. Option C. Ignores human safety. Handling areas individually. Option D. Causes inefficiencies and lack of coordination. Question 26. When improving a process that shows unexpected results, a research lab is adjusting its testing protocols. What is the best approach to ensure accurate and reliable outcomes? A. Analyze potential sources of variability and refine methodologies. B. Change protocols randomly until desired results are achieved. C. Ignore inconsistencies if they don't affect short-term outcomes. D. Remove key quality control measures to speed up testing. Answer A. Analyze potential sources of variability and refine methodologies. Explanation. Identifying variability ensures accuracy and reproducibility. Option A. Random changes. Option B. Introduce uncontrolled variables. Ignoring inconsistencies. Option C. Compromises scientific integrity. Removing quality control. Option D. Leads to unreliable results. Question 27. In an environment where different components must interact seamlessly and a firm is integrating multiple software platforms, what is the best strategy for a smooth integration? A. Use standardized interfaces and conduct thorough interoperability testing. B. Force all systems to operate on a single outdated framework. C. Ignore integration challenges and address them later. D. Let departments develop independent systems without compatibility checks. Answer A. Use standardized interfaces and conduct thorough interoperability testing. Explanation. Standardized interfaces and interoperability testing. Option A. Ensure seamless functionality. Using outdated frameworks. Option B. Limits flexibility. Ignoring challenges. Option C. Leads to future failures. Independent systems. Option D. Create data silos and inefficiencies. Question 20. During a seamless transition where continuity must be maintained, an airline is upgrading its air traffic control systems. What is the best approach to minimize disruptions? A. Implement upgrades in phases with redundant systems running in parallel. B. Shut down operations entirely until the transition is complete. C. Rely solely on new technology without backup procedures. D. Roll out the new system instantly without testing. Answer A. Implement upgrades in phases with redundant systems running in parallel. Explanation. Phased implementation with redundancy. Option A ensures continuity. A full shutdown. Option B is disruptive, relying only on new tech. Option C is risky without backups. Instant rollout. Option D increases failure risks. Question 29. When developing a solution that must address opposing needs, a city government is designing a traffic system that balances vehicle flow and pedestrian safety. What is the best approach? A. Use data-driven models to optimize traffic while ensuring pedestrian zones. B. Focus entirely on vehicle flow, disregarding pedestrian needs. C. Ban all cars to prioritize pedestrian movement. D. Ignore traffic problems and maintain the current system. Answer: A. Use data-driven models to optimize traffic while ensuring pedestrian zones. Explanation: a data-driven approach balances both priorities. Option A. Prioritizing vehicles alone. Option B. Compromises safety. Banning cars. Option C. Disrupts economic activity. Ignoring problems. Option D. Prevents progress. Question 30. In a high-stakes environment where multiple challenges must be addressed simultaneously, a hospital is responding to a sudden surge in emergency cases due to a natural disaster. What is the best approach to manage resources effectively while ensuring patient care? A. Implement a triage system to prioritize patients based on medical urgency. B. Treat patients on a first-come, first-served basis regardless of severity. C. Focus only on patients with minor injuries to clear space faster. D. Allocate resources evenly without considering patient conditions. Answer: A. Implement a triage system to prioritize patients based on medical urgency. Explanation: a triage system, option A, ensures that patients in critical condition receive care first, improving survival rates. A first-come, first-served approach, option B, may delay urgent care for critical patients, focusing only on minor injuries. Option C neglects life-threatening cases. Allocating resources without prioritization, option D, wastes medical capacity and leads to poorer outcomes.